All right, today we're jumping into a really fascinating, super deliberate financial move from one of Africa's biggest tech titans. It's a masterclass in corporate strategy that, at first glance, is a real head-scratcher. So let's get right into it.
So here's the central puzzle. It just seems backwards, right? I mean, why would a massive company pay off a huge chunk of debt only to immediately turn around and take on a new, smaller loan? It's definitely not because they're short on cash. No, this was a calculated reset, and the thinking behind it is pretty brilliant.
And the architect behind this whole maneuver is Masiyiwa, the founder of the Pan-African digital infrastructure giant Liquid Intelligent Technologies. Now this guy, he's not one for big, flashy press releases. He lets the numbers do the talking. So when a move like this happens, you know you've got to look closely to understand the message he's sending. Okay, let's start with the hard facts of the deal. What exactly happened here, and when did it all go down? So, the main event was on April 20th. Masiyiwa's company, Liquid, paid off a massive $620 million bond. And get this, they did it months before it was even due. Then, in its place, they issued a brand new, and you'll notice much smaller, $300 million bond. To really get the why behind this, we first have to understand the what. So let's decode this debt swap and break down the mechanics of what was actually exchanged. First off, a super quick refresher. A corporate bond is basically just a big IOU. Investors lend money to a company, and the company promises to pay it all back by a certain date, the maturity date, and they pay interest along the way. It's a totally standard way for big companies to raise money. Okay, now this is where it gets really interesting when you see it side by side. First, just look at the amounts. The debt drops by more than half, from $620 million all the way down to $300 million. But just as important is the maturity date. That old debt was due in just a few months. The new debt? Well, they kicked that can way down the road to 2031. That's a 5-year extension. But the real masterstroke is in the type. The old debt was senior secured notes. Think of it kind of like a mortgage. It was backed by specific company assets, which is safe for lenders, sure, but it's pretty restrictive for the company. The new debt is a Eurobond. Now, that doesn't mean it's in euros. It means it's sold internationally to a way bigger pool of investors. That gives them so much more flexibility, and honestly, it signals huge global confidence.
So, now that we've got the mechanics down, we can finally get to the heart of it, the strategy. Because let me tell you, this was not just some financial spring cleaning. It was a seriously forward-looking power play.
So here's the deal. This one move achieved 4 critical things all at once. First, it instantly lowered the company's total debt. Second, it managed risk by getting rid of that big payment that was looming just around the corner. Third, it extended their financial runway, giving them 5 more years of breathing room. And finally, all of this serves one ultimate goal: to fuel future growth. And what does that growth actually look like in the real world? Well, with less debt to worry about and no refinancing deadline on the horizon, Liquid can now aggressively put their money where it really matters, into building concrete, continent-spanning infrastructure. We're talking more subsea cables, more massive data centers, and more fiber connecting all of Africa.
Now, this all sounds like a pretty solid strategy on paper, but how did the real world react? How did the people with the money, the big institutional investors, actually respond to this move?
Well, the answer can be summed up in one single powerful number: 2.5 times. That means for every $1 in bonds Liquid was offering, investors were scrambling to put in $2.50. The demand was just overwhelming. This wasn't just quiet acceptance. It was a massive vote of confidence from the global market and Liquid's strategy, and really in the future of African tech. And this quote from Finance Wire just captures the bigger significance perfectly. This one successful bond issue basically sent a signal to investment desks all over the world. It validates that putting your money into African digital infrastructure isn't just some niche side bet anymore. No, it's a credible, serious, institutional-grade asset class. So let's zoom out, because this isn't really just about one company's balance sheet. This is about the engine that's literally building Africa's digital future. To understand the sheer scale of what we're talking about, just consider this number for a second. 100,000 kilometers. That's the length of the fiber network that Masiyiwa and Liquid have already built across the continent. I mean, that's more than twice the circumference of the entire Earth. It's the digital spine that this new capital is now going to strengthen and expand even further. And Liquid's footprint is incredibly diverse. It is not just about fiber. We're talking about operations across 31 countries, covering everything from satellite and cloud services to cybersecurity and data centers. This whole balance sheet reset is designed to power growth across every single one of these critical areas. So we end on this question. This single, quiet financial transaction was called a defining data point by one source. And I think that nails it. The balance sheet is reset, the big debt wall has been pushed back, and global investors are lining up. Could this seemingly simple debt swap be the clearest signal yet that the race to build out Africa's next digital decade has just kicked into a whole new gear?